Take a breath for a second. Seriously. Put the chart down. Close the app. Stop staring at those candles like they were going to suddenly confess the truth if you refresh one more time. Whether silver ticks up to 96 or slips back to $90 in the next hour, honestly doesn't matter anymore. I know that sounds insane coming from someone who lives and breathes this market, but hear me out. The price you see on your screen right now is more like a ghost, an echo of a system that, for all practical purposes, stopped functioning earlier this week. What actually matters now isn't the number flashing on your phone. What matters is whether the market itself still works. The pipes, the gears, the quiet agreements that allow metal to move from one hand to another without chaos. And as of Wednesday, January 21st, 2026, those pipes have burst. The gears are jammed. The U.S. wholesale silver market has frozen solid. This isn't hyperbole. This isn't clickbait. For years, we've warned about tight supply, shrinking inventories, mines struggling to keep up. But what's happening now is not a shortage. A shortage means the market is stressed but still alive. This is something much worse. This is a full-blown system failure. Think cardiac arrest, not a fever. Earlier today, we received internal trade sheets from one of the largest authorized purchasers connected directly to the U.S. Mint. These are not small players. These are the whales, the firms with massive balance sheets, billion-dollar credit lines, and direct access to government supply. They are the heart that pumps metal through the entire Western precious metals ecosystem. Every morning like clockwork, usually around 8 a.m., these wholesalers send out a trade sheet. It's essentially a menu for the entire industry. Thousands of products listed. American Silver Eagles, Canadian Maples, 100-ounce bars. Alongside each product, 2 numbers. A bid, what they'll pay you, and an ask, what they'll sell it for. That sheet is proof of life. It's liquidity in written form. Today, that sheet came in blank. I'm not exaggerating. The sell side, what dealers can actually buy, was a wall of red text. Sold out, sold out, sold out. Eagles, gone. Maples, not available. Generic rounds, back order with no ETA. 100-ounce industrial bars? Forget it. They're not even taking orders. The shelves at the wholesale level aren't just empty, they've been scraped clean. If a local coin shop called this wholesaler today and said, "I've got a client with $1 million cash who wants silver," the answer would be, "Sorry, we can't help you." Not because they don't want the business, because the metal quite literally does not exist in their system. Now, here's where it gets truly unsettling. In a normal shortage, dealers panic, but in a productive way. They raise bids, they beg for inventory, they offer premiums over spot to pull metal out of hiding. High prices cure low supply. That's Econ 101. But today, something happened that shouldn't happen. On the buy side, instead of higher bids, the status reads, no bid. Let that sink in. The biggest wholesalers in the country have stopped buying silver altogether. They've shut off the buy button. You could show up with a truckload of pristine bars, and they wouldn't even open the gate. No offer, no negotiation. Just a polite but firm, "We can't take it." How does that make sense? How can a company be completely sold out and simultaneously refuse to buy more metal? That sounds like madness, until you realize this is no longer a supply crisis. It's a capital crisis. They don't lack desire, they lack cash. Their credit lines are maxed out. Their accounts are frozen by internal limits. Their liquidity has evaporated. On paper, many of them still look solvent. They have assets, warehouses, inventory. But they are paralyzed. They can't write the check. And without the ability to pay, trade stops. At that moment, the market ceases to be a market. A market requires both a buyer and a seller. Right now, buyers can't find sellers, sellers can't find buyers, and the bridge between them, the wholesale system, has collapsed straight into the ocean. When that happens, everything downstream locks up. Coin shops can't restock, so they shut their doors or put up call for availability signs. Online dealers can't hedge, so spreads explode or websites quietly go offline. Liquidity doesn't thin out, it vanishes. So, how did we get here? How did the most capitalized firms in the industry run out of money during the biggest silver rally in modern history? Shouldn't they be celebrating? Shouldn't they be swimming in profits and shopping for beachfront property? Here's the cruel irony. The very tool designed to protect them is what's killing them. To understand this, you have to understand the hedge and the trap hidden inside it. Wholesale bullion dealers aren't speculators. They're logistics operators. Think moving company, not casino. Their goal isn't to bet on silver going up or down. Their goal is to buy metal at spot plus $1 and sell it at spot plus $2. Rinse, repeat, volume over heroics. But holding tens of millions of dollars in inventory is dangerous if prices move sharply. So they hedge. Every ounce of physical silver they buy, they short an equivalent amount on the futures market. This makes them market neutral. If silver drops, they lose on the metal, but win on the short. Banks love this. It looks safe. It unlocks cheap credit. In calm or even moderately bullish markets, this works beautifully. In a vertical explosive bull market, it's a financial suicide vest. Let's walk through the math. A dealer buys 1 million ounces of silver at $25. That's $25 million to hedge. They short 1 million ounces on the futures market at the same price. Balanced, safe. Everyone sleeps well. Then the world goes sideways. Panic, government buying, geopolitics. Silver rockets to $95. On the asset side, it looks incredible. That silver is now worth $95 million. On paper, they look like geniuses. But on the liability side, they're still short from $25. That's a $70 loss per ounce. $70 million in losses? Yes, in theory, it still balances. The asset covers the liability. But theory doesn't pay margin calls. The physical metal just sits there. It doesn't generate cash unless you sell it. The futures exchange, however, wants cash now. Every single dollar move higher triggers a margin call. $1 up means $1 million wired by morning. At $95 silver, that's a tsunami of cash demands. Even massive firms can't survive that kind of drain. Banks get nervous, credit lines get pulled, liquidity disappears, and that's how success becomes failure. Not because silver went up, but because it went up too fast for a system built on leverage and paper promises to handle. So if you're wondering why the price feels disconnected, why availability has vanished, why nothing makes sense anymore, it's because the screen you were staring at is no longer the market. The real market is frozen, and frozen systems don't care about candles. Picture this for a moment. Silver jumps $70 almost overnight. Sounds great, right? Except for one small problem. For every dollar that move happens, the dealers who are hedged have to send real money to the exchange. Not silver, not IOUs, not we'll settle later, actual fiat. Cold, boring, old-fashioned cash. So when the price rips higher by $70, the bill isn't theoretical. It's $70 million, wired now, preferably before breakfast. Now ask yourself a very simple question. Where exactly is a bullion dealer supposed to find $70 million in cash on short notice? Spoiler alert, it's not sitting idle in their checking account. Their capital is locked up in metal stacked neatly in warehouses. That silver may be valuable, but it doesn't pay margin calls. So they do what they've always done. They borrow, they tap their revolving credit lines with the big bullion banks. JP Morgan, Bank of America, HSBC. These lines are built for normal markets. A few dollars up, a few dollars down. Manageable volatility. What we are living through right now is not that. This is a violent repricing event bordering on hyperinflationary behavior. The move has been so fast, so relentless, that it has vaporized those credit lines. The dealers have drawn every last dollar the banks were willing to lend just to keep their futures positions alive. They've effectively maxed out the card. And eventually, the phone rings. The bank says, politely but firmly, "That's it. No more credit. You're too leveraged and we're done extending risk." That moment is the liquidity freeze. Here's the irony that makes the situation almost darkly funny. These dealers are sitting on mountains of silver worth hundreds of millions of dollars. On paper, they're rich. In reality, they're broke. They're cash poor and completely illiquid. They can't sell the silver fast enough to raise the cash needed to meet margin. And even if they could, unwinding those hedges would crystallize massive losses they don't have the liquidity to absorb. And because the credit lines are exhausted, they can't buy new metal either. If you walk in with silver to sell, they need cash to pay you. But all of their cash is already spoken for. It's flowing straight to the futures exchange, drip by drip, to satisfy the margin clerks. They can't even write a modest check without risking default. So the buying desk shuts down. The sign flips to no bid. Operations freeze. This is the ultimate punchline. The dealers use the dollar-based future system to protect themselves. Now the collapse of confidence in the dollar, which is driving silver higher, is destroying the very hedge holding their business together. They're chained to a paper system that's taking on water fast. Physical silver wants to run. The paper anchor is dragging everyone down. And if you think the banks are riding in on white horses to save the day, forget it. The banks are the ones collecting the margin calls. They're on the other side of the trade. JP Morgan is long, the dealers are short. Every dollar higher transfers cash from the dealer to the bank. When a dealer finally breaks and misses a call, the bank doesn't shed a tear. They seize the collateral. Trucks roll up to warehouses, and the physical silver changes hands. This isn't a rescue. It's a consolidation, a quiet takeover. So what you have now in the United States wholesale market is something like suspended animation, a zombie system. Screens are on, but nobody's home. Sold out flashes, because selling metal means realizing hedge losses they can't afford. No bid flashes, because there's no credit left to buy. It's a deadlock born from financial engineering. While New York is choking on derivatives and balance sheets, the rest of the world is not standing around waiting. Most of the world doesn't hedge like this. They operate on cash and carry. And one country, in particular, has smelled opportunity in the air. Turn your attention east, all the way to India. While U.S. dealers stare at margin statements, Indian dealers are staring at record prices and smiling. They've turned on the vacuum cleaner. The center of gravity for the global silver market has shifted violently and decisively about 5,000 miles east. It has landed in Mumbai. If you want to see what silver is really worth in a market without paper shackles, look at the multi-commodity exchange of India. The latest closing data is nothing short of historic. Silver on the MCX has blown through every previous record and settled around $113.88 per ounce. That's not a fancy collectible coin or a boutique product. That's the wholesale benchmark price for a kilogram bar. Converted into local terms, Indian buyers are paying roughly 335,521 rupees per kilogram. 6 months ago, that number would have sounded like science fiction. Today, it's simply the market clearing price. Now compare that with the number blinking on American screens. $95 versus $113. That gap changes everything. Traditionally, silver flows from mines in Mexico through refineries and vaults in London and New York. That route has now been hijacked. No rational refiner is going to sell metal into New York at $95 when they can ship it to Mumbai and get paid $113. Capital follows profit. Always has. The West is being drained. London is being drained. The metal is leaving markets where silver is treated like a derivative chip and heading to markets where it's treated as money. The urgency in India isn't random either. For the past couple of days, rumors have been ripping through the bazaars of Delhi and Mumbai that the government is preparing a major import tariff on silver to defend the rupee. Anyone familiar with Indian policy knows how this works. When they act fast, sometimes overnight. So people aren't waiting, they're front-running the policy. This isn't speculative day trading. This is cultural buying. Housewives buying jewelry, farmers buying anklets, business owners buying bars. It's wealth preservation, not leverage. And unlike American investors clicking buy on an ETF, Indians take delivery. They hold it. They remove it from the system. That roughly $18 premium is a death sentence for the futures exchange. You cannot maintain a paper price at $95 when real metal is trading 20% higher elsewhere. The arbitrage is too strong. Traders who still have access to credit are buying cheap paper contracts in New York, standing for delivery and shipping the metal east. COMEX is being stripped to feed the MCX. This is why the U.S. wholesale market is breaking. American dealers can't compete. Their customers won't pay $113, so the metal simply bypasses the country. The United States has become a flyover zone in the global silver trade. The bars go over New York and land in Mumbai. That creates a vicious feedback loop. As metal leaves the West, shortages deepen, sold-out signs become permanent fixtures. The liquidity crisis worsens because nothing flows back in to restore balance. It's a one-way street. India buys, the West bleeds. Meanwhile, something deeply unsettling is happening inside the paper casino that's supposed to regulate all of this. The behavior of the big banks on the futures exchange has changed. For weeks, they were rolling positions forward, kicking obligations down the road, avoiding delivery. But on Tuesday, the game changed. We analyzed the delivery data from the close, and the shift is unmistakable. Instead of rolling contracts into the future, banks began standing their ground and demanding metal now. January, a month that's usually a delivery ghost town, has exploded to over 42 million ounces delivered. In a normal year, you might see 2 or 3 million, and this is a 2,000% surge in the quietest period of the calendar. This isn't noise, it's a bank run. The holders looked at India's premium, looked at the empty shelves, and decided they weren't waiting until March. They wanted bars today. And leading the charge, once again, is JP Morgan. Out of 243 delivery notices issued in one session, JP Morgan's house account stopped 176 of them, 72% of the total. They're hoovering up metal like a vacuum inside the vault. Why now? Because they see what's coming. They see the wholesale freeze. They see India draining London. They know that waiting risks finding empty vaults later. So they're taking possession while they still can. And January isn't the end of the story. February, another month that's supposed to be quiet, is showing open interest, equivalent to roughly 11 million ounces. If those holders stand for delivery, and with India paying over $113, why wouldn't they? It could break what's left of available inventory. This isn't just a rally anymore, it's a transfer. A reallocation of physical metal from a paper-driven system to one that still believes money should be real. That quiet window the banks always count on, that seasonal slowdown where everyone exhales and buys time, never arrived. Winter was supposed to bring a pause. Instead, the drain sped up. What you're watching now is what happens when a market loses faith in tomorrow. In a functioning system, traders are comfortable holding contracts for future delivery. They trust that the metal will be there, the counterparties will perform, and the plumbing will hold. In a failing system, nobody wants a promise. Everyone wants possession. Now. When rolling stops, trust has already left the building. It's the financial equivalent of everyone lining up at the exit at the same time. The banks are effectively saying, I don't trust you to have this silver next month. I want it loaded on a truck by Friday. That mindset is the psychology of a run, and it fits perfectly with the liquidity freeze we've been describing. The dealers are freezing because they're short. Banks are taking delivery because they're long. Capital is moving fast, from the weak hands to the strong hands, from hedged middlemen to vaults controlled by J.P. Morgan, and to buyers in India who done T-deal in promises. This is consolidation on a scale most people have never lived through. Here's the part that makes this so brutal for the American precious metals industry. The dealers, wholesalers, transporters, the entire network is not collapsing because they were wrong about silver. They were right, painfully right. They're collapsing because they were wrong about the dollar. They anchored a sound money business to an unsound money foundation. They used a dollar-based system to ensure real assets, and now the dollar is dragging the whole structure into the abyss. This is where the irony cuts deep. Being market neutral in a hyperinflationary environment isn't safety. It's a death sentence. The hedge that looked so prudent on a risk committee slide deck becomes an anchor when the currency itself starts failing. When a dealer shorts futures to protect inventory, what are they really betting on? They're betting that silver and the dollar will remain in balance. They're trusting a paper derivative, born inside the fiat system, to safeguard physical metal. They tied their lifeboat to the Titanic and convinced themselves the chain was security. Now the ship is sinking. The dollar weakens, silver explodes higher, and that same chain pulls the lifeboat under. Every margin call is a tax paid for trusting fiat. Every wire sent to cover a short position is a penalty for not simply owning the metal outright. Dealers insured themselves against a price drop, but they never insured themselves against a melt-up. They never planned for the dollar dying faster than their spreadsheets could update. There is another layer to this disaster that doesn't get talked about enough: capital intensity. When silver was $25 an ounce, a wholesaler with a $10 million credit line could move roughly 400,000 ounces at a time. That's a serious operation. Today, with silver near $95, that same credit line barely covers 100,000 ounces. Their purchasing power has been slashed by 3/4. The metal got more expensive, but the credit didn't scale with it. In fact, it shrank. Banks see volatility and pull back, not lean in, so dealers are trapped. The polite phrase is financial constraints. The honest translation is we're broke. Silver has simply become too expensive for the middlemen to handle. It is like a gas station that can afford to buy fuel because oil hit $500 a barrel. Everyone still needs gas. The station still has customers. But the doors close anyway. That's exactly what's happening here. Demand is exploding, supply is desired, and yet the buy button is turned off because working capital is gone. This creates a bizarre and uncomfortable misalignment. You, the investor, are cheering for $150 silver. You want higher prices. Meanwhile, the dealer you buy from is quietly praying for a crash. They want $50 silver just so the margin calls stop and their credit goes further. The industry is now in conflict with its own customer base. Rising prices reward holders but destroy distributors. The just-in-time, highly leveraged, paper-hedged model cannot survive this environment. It was built for stability, not currency decay. As U.S. dealers freeze and fail, they leave a vacuum. And nature, especially financial nature, hates a vacuum. We already know who fills it. India fills it. China fills it. J.P. Morgan fills it. The players with real capital, the ones who actually want the metal and don't need to hedge it, step in. This is a transfer of silver from paper hands to diamond hands, from Western balance sheets to Eastern vaults. So where does that leave you? Standing in front of a machine that no longer works, holding fiat currency in a world where sellers of real assets can't accept it. The wholesale market didn't pause. It died. And this isn't something you wait out for a few weeks hoping for normal to return. This is the new normal. Let's be blunt about the verdict. We've seen the trade sheets, sold out on the sell side, no bid on the buy side. We've seen silver trade at 113s in India while New York pretends $95 is real. We've watched the U.S. wholesale network suffocate under debt, margin calls, and shrinking credit. The diagnosis isn't complicated, it's terminal. The U.S. physical silver market is in cardiac arrest. The heart has stopped. The blood isn't circulating, the lights are on, but functionally it's over. You need to understand what no bid really means. It means liquidity is gone. The ability to instantly turn metal into cash has evaporated. If you're holding silver in the U.S. right now, you're holding an asset that's disconnected from the local financial system. You can't sell it to wholesalers because they have no money. You can't buy it from them because they have no inventory. The bridge is out. The only way across the river is to go where the bridge still stands. And that bridge isn't in New York or London anymore. It's in Mumbai. It's in Shanghai. This leads to the most important realization of all. The price on your screen is no longer relevant. That $95 quote is a zombie price. It exists inside a computer model where infinite leverage and infinite paper promises still pretend to function. In the real world, where silver is needed for solar panels, electronics, and wealth preservation, that price is fiction. The real price is 113. The real price is whatever a buyer paying cash for physical metal is willing to hand over today. The gap between the zombie price and the real price is the cost of the collapse of Western trading infrastructure. We are witnessing the end of an era. For half a century, New York and London dictated the silver price to the world using paper derivatives to override physical reality. That control has broken. The West ran out of metal, and then it ran out of credit to hide the fact. The baton has been passed. India is setting the price. China is setting the floor. The United States is watching its own financial plumbing fail in real time. So what's your move? If you're holding paper, ETFs, unallocated accounts, pooled products, you're standing in the middle of the liquidity freeze. You're holding a claim on a system that may not survive the week. A promise from counterparties already shutting their doors. If you can redeem for physical, do it. If you can't, understand exactly what risk you're carrying. And if you're holding physical silver, do not sell it. Donna T let a desperate dealer convince you to part with real money for a zombie price so they can survive one more margin cycle. Don't throw your life raft to a sinking institution. Your silver is real. The paper market isn't. The wholesale system had to die for the true market to emerge. Manipulation ends when manipulators run out of capital. This is the reset. The sold-out signs aren't temporary. The silence of no bid is the calm before the reprice. The Western system is finished. The market, as we knew it, is dead. And paradoxically, that's exactly why the price finally gets to live.